Before we start, if you want calm, honest, data-driven explanations about money, markets, and investing, subscribe to the channel. It's free, which is a rare experience in 2026. Now let's talk about what just happened, because the last few weeks in gold and silver have confused a lot of people. Gold recently moved above $5,000 per ounce. Silver pushed above $120 per ounce. Those are not normal numbers. Those are historical, psychological levels. And then, both dropped. Gold pulled back. Silver fell below $80. And the mood changed almost instantly. From precious metals are unstoppable to, was that the top? So instead of reacting emotionally, let's slow this down and understand what is actually happening. Because gold and silver do not move randomly. They move in response to policy, power, and global economics. This is not financial advice. This is financial reality. First, we need to understand why prices went up so aggressively in the first place. Because the move to 5,000 gold and 120 silver did not come from nowhere. It came from expectations around interest rates. After a long tightening cycle from the Federal Reserve, markets began to expect rate cuts. Lower expected rates mean lower real yields. Lower real yields historically support gold. At the same time, global debt levels kept rising. Governments are carrying more debt than at any time in modern history, and there are only a few ways to deal with that. You can raise taxes, you can cut spending, or you can allow your currency to lose value over time. Historically, the third option is the most common, and that is one of the core long-term reasons people hold gold. Then you add central bank demand. Over the last decade, central banks have been accumulating gold at record pace, especially countries trying to reduce dependence on the dollar system, including strategic moves from China. Then you add geopolitical tension, trade fragmentation, regional conflicts, power competition between the United States and China. All of this increases demand for neutral reserve assets, and gold sits at the center of that system. When you combine all of these forces, prices can move very fast, and that is exactly what we saw. Now let's talk about the drop, because the drop is not random either. When an asset rises quickly, large funds take profits. That creates selling pressure. This is normal. At the same time, the dollar strengthened slightly in the short term, and because gold and silver are priced in dollars, a stronger dollar usually means lower metal prices. Real yields also moved slightly higher, and gold is very sensitive to real yields. And then there is positioning. When too many traders are on one side of a trade, even good news stops pushing prices higher. That's when corrections begin. So what we are seeing now is not a collapse. It is the natural countermove after a very strong rally. Now let's address something that confuses many investors. You open an app, and you see silver at maybe $75. But when you try to buy physical silver, it costs $90 or even $100 per ounce. So people ask, why is the app price lower than what I pay in real life? There are 3 reasons. First, the price you see on apps is the spot price. That price is based on futures markets, paper contracts, financial instruments. Physical silver is a real product. It needs to be mined, refined, minted, shipped, stored, and sold. That creates a premium. Second, demand for physical metal has been high. When demand rises, premiums increase. Third, silver is not just a monetary metal. It is an industrial metal, used in solar panels, electronics, batteries, and medical equipment. When industrial demand rises, physical supply tightens. That increases premiums even more. So the difference between app price and physical price is not a mistake. It is 2 different markets interacting. Now let's talk about China, because this is one of the most important long-term factors. China has been increasing its involvement in precious metals, not just gold, but silver as well. Part of this is industrial. China is the world's largest producer of solar panels, electronics, and electric vehicle components. All of these require silver. Part of it is strategic. China is slowly diversifying reserves away from the dollar system. Gold is the primary asset for that, but silver plays a supporting role. Part of it is domestic demand. Retail investors in China have more access to metals than before. Demand has grown. And part of it is geopolitical. In a world where financial systems are increasingly used as political tools, countries want assets that cannot be frozen, sanctioned, or controlled by another country. Gold and silver provide that. So this is not short-term speculation. This is long-term positioning. Now zoom out to the last 10 years, because perspective changes everything. In 2015, gold was close to $1,050. Silver was around $14. By 2020, gold reached $2,000. Silver approached $30. That is a massive move. And during that period, there were multiple corrections of 15 to 25%. Each one felt like the end. None of them were. Now we are in a new phase. Higher debt, higher geopolitical tension, more constrained monetary policy, stronger central bank demand. Which means the long-term backdrop for metals is still intact. So what does a rational investor actually do with all of this? First, do not chase vertical moves. Buying after emotional spikes increases risk. Second, do not panic sell corrections. Corrections are part of the cycle. Third, use time instead of timing. Instead of trying to catch the exact bottom, accumulate gradually, in phases, over time. Fourth, be clear about why you own metals. Inflation protection, currency hedge, geopolitical hedge, diversification. Clarity reduces emotional decisions. Fifth, position size properly. Gold and silver are part of a portfolio, not the entire strategy. And finally, understand volatility. Silver especially is more volatile than gold. It moves more, both up and down. That is normal behavior. Now let's end with perspective. Gold moving above 5000 and then pulling back. Silver moving above 120 and then dropping below 80. Feels dramatic. But when you look at the last decade, it fits inside a repeating cycle. Expansion, correction, stabilization, expansion again. The forces behind precious metals, debt, policy, currency risk, geopolitics, central bank demand, have not disappeared. Only the short-term price has changed. So the real question is not, why did price drop this week? The real question is, has the long-term reason for owning these assets changed? If the answer is no, then what you are seeing is part of a cycle, not the end of a story. This is not financial advice. This is financial reality. If you want more calm, clear, honest breakdowns like this, subscribe to the channel, and I'll see you in the next video.